Hi there, everybody. It is time to get started, and we thank you for being right on time today. Very nice to see you in our room. This is Craig at Max Trading, here along with Chris and Eusebio, and all of us are very excited about today's presentation. Fact is, you are the first traders to learn about the new upgraded edition of Max training courses, and there will never be a better time to add Max methods to your charts to give your trading results a big boost. It was more than 3 years ago, I believe, that Eusebio first saw the need for a reliable indicator to help deal with the changing characteristics of the markets. And so he began to develop and test the Max Enhanced Trade Format Indicator. We call it the ETF. A lot easier to say. It has been available to upper-level members in the Max community and has proven itself over time again and again as a very effective addition to Max trading. And now we are ready to incorporate ETF into every level of Max training. And that makes this a really exciting time to get in on Max trading. This means that you can select any level of Max training, and you will also get the ETF indicator and methods, learning how to use it. For you, this can make a huge difference, and it will give you a real shot at becoming successful with your trading. And more good news, tuition rates are not changing. We are not increasing the tuition. We're keeping exactly the same tuition for these upgraded trading opportunities. And for Max members who are present today, and thank you for coming, by the way, but you'll want to know that we'll have some special upgrade opportunities for you, and we'll share those with you sometime next week. We do think it is very important that traders get to see our trading methods in real time, live, real-time charts. So I will send you an invitation to attend a real-time trading session so that you can see for yourself the effectiveness of the Max trading system and the ETF indicator. As the developer of ETF, there is nobody better suited than Eusebio to take us into the world of Max trading. Eusebio is a phenomenal trader. Many of you have already seen him trading, and you're aware of this. And fortunately for all of us, he is also a skilled teacher. You are going to appreciate his passion for helping traders become successful. Eusebio, we thank you so much for sharing your weekend with us, and I'll turn the microphone over to you.
Thank you very much, Craig, and welcome to all of you present during this presentation. And for those of you who will also follow the recorded video. So before describing the Max, let me give you just a very small background of who I am. Perhaps you have recognized that with my accent, I don't have a complete or a good mastering of English, which is not my mother language. I am in fact a Belgian trader. I live in Belgium and France, and so I will make my best to be understood, and feel free to ask questions if necessary. And so I am a former software engineer. I have worked in that area for almost 30 years. And the last 15 years of my professional career has been dedicated to the bank industry in important banks in Europe, Luxembourg, France, UK, Germany, and so on. And this has given to me the opportunity to meet and to exchange with some bank traders, and so to have just a small idea on how they are trading. But this has helped to increase, to motivate and to increase my passion for the investment and the trading activity, because indeed I'm developing that idea for more than 30 years now, and I've experienced almost all the usual financial market, like the stock market, the options market, the futures, and of course since many 2000 the forex trading, the spot forex trading. And so what I'm going to present to you now is the Max trading system with the new upgrade Craig has mentioned. I will illustrate that upgrade with some examples, and then if we have time I will just mention a few words about the money management with the Max. So a small history about the Max trading system. And I will sometimes use only the word the max for just to make it easier. So the max has been created many years ago by late Dr. Jim Pruitt, known by his students as Tiger. This was with affection his students has given to him that name because he had in fact a very strong temperament, and being rolled by the tiger was a very tremendous experience, but very educative experience too. And the aim of Jim was to give traders a very powerful and reliable trading method. I like to use the word method instead of system, because indeed the max is a methodology instead of a set of fixed and rigid rules, as I will explain later. But there are two skills which must be developed in order to be successful with the max: work and commitment. Understanding, assimilating, and applying the max requires a lot of work, because even if there are a few concepts, there are many rules, many details which have to be taken into account. And so the commitment to invest in these efforts is very important. If your objective is only just to make money, failure is almost a guarantee. Your motivation, as for any important objective in life, is very important. So the commitment is important, because this is the guarantee you will sustain the necessary effort to learn and to apply correctly the max. There are also other skills which are very important: discipline, patience, persistence, concentration, confidence, and I like to add conviction. Discipline and patience, these two skills are obvious indeed, because the max is a methodology. This means that the rules of the max must be applied with discipline without never deviating from them. There are some exceptions, I call discretionary situations, which are extremely limited and always based on trade risk management arguments. And patience, a rule, in fact, as well as an entry rule or an exit rule, is always a set of conditions to be fulfilled. And so we need to have the patience to wait for all these conditions to be fulfilled. Persistence is also very important. Even if the max has a good winning rate, this means that 100% winning rate is never achieved. And so a trader using the max may have losing streaks. For example, you need to know that with 70 or even an 80% winning rate, you can still have losing streaks made of 4, 5, up to 10 losing trades in a row. 10 losing trades in a row. This is not impossible. This is even statistically normal. And so persistence consists in continuing to apply the method with patience and disciplines when you are experiencing such a drawdown, in fact. And the drawdown, the amount of the drawdown, can always be limited with a good trade risk management and a good money management. And so persistence is important. Many traders jump from one system to another after 2, 3, 4 losing trades in a row. This is not good, because this is not recognizing or understanding the statistical fact about trading. So persistence is important. Concentration, I have mentioned the max is made of a lot of detail. So when we trade, whatever the time frame, a small time frame or a higher time frame, concentration, dedication is important to never miss every detail we have to take into account. Confidence and conviction, indeed, we need to be convinced that we can succeed in trading, and this confidence and conviction may be built on several levels. First of all, confidence in the market, in the ability of the market to create the movement we want to trade. Confidence in the max by practicing the max, and building the confidence about the ability of the max to catch most of these movements and to produce profits along these movements. And confidence on ourselves as a trader, as a max trader, by practicing. We need to be confident enough in ourselves, in our ability to recognize good opportunities and to recognize risky situations, so when we have to decide what to do following the rules. And so whenever we develop, we explain a trading method, there are several things which must be mentioned. And I don't often see such kind of explanation when I concentrate or when I try to understand some other trading methodologies. So for me, it is important to always define the movement we want to trade. When we say that the max trading system is a trend following system, what does it mean? What is a trend? So it is always essential to define the kind of movement we want to trade. Then it is, of course, important to define when and how such a movement may start. Of course, I say may start because we never know how far such a movement will go. It may be a small movement, it may be a very ample movement. And the way to define how such a movement may start and become tradable, we will call it an entry setup. This means a set of conditions allowing us to open a trade, to recognize an opportunity and then to open a trade. And then to open the trade, we need to check that that entry or these entry setups are valid. And we have always several types of validations, several levels of validation, a technical aspect, a risk aspect, and a global context aspect. And then we have to define how to handle the trade along the movement in order to reduce or possibly cancel the risk. In such a way we have a risk-free trade, and then once we are in a risk-free trade, how to optimize the profit we can extract from that trade in that movement. And then, of course, we have to define how or when a movement, such a movement, can exhaust. We can never be sure 100% when a movement will end, but we can define when it will exhaust. And perhaps several bars later, several minutes, several hours later, the same trend may resume. But an exhaustion of a movement can be a good opportunity to close the trade. And so this is what we do with the max trading system. We apply all these 5 steps in order to define how to trade a movement. And so what is the max? And I will today make the distinction between the historical max and the new max, in fact. And the new max, we will even call it the max ETF, in fact. And so the max is an acronym. Let me take the red spot here. It's an acronym for 3 words. The M stands for momentum, the A stands for acceleration, the X stands for exit. And indeed, we need to see momentum before considering opening a trade, because momentum and, I should add, volatility are the 2 main conditions in order to have a trade opportunity. Then acceleration. When the price unfolds an ample movement, we can progressively add to our trade in order to progressively build a larger position and increase the profit we can extract from that movement. And this is what we call the acceleration phase. In fact, to be more accurate, we should say the profit acceleration phase. And then the X stands for exit. While we are trading a movement, we will have to take some partial exit until when we recognize the movement is exhausting, and then we will close the remaining opened trade. And so the MAXO is essentially a trend following method. In the past, in the advanced level of the MAX, we teach also how to trade a counter trend movement when the price is in an uptrend, for example, but is temporarily going downward or vice versa. And also in some circumstances when we can trade consolidation area or range movement. But these concepts now are unified in the new MAX ETF method, as I will explain in a moment. And with the MAX, we have also a very strict risk, trade risk management and a very risk money management system. So in such a way to always control potential drawdown we may face over time. And so the MAX, as it has been defined by Jim, is applicable to any time frame and to any financial and tradable market, the futures market, the forex, of course, the indices market, and so on and so on. It is also important to understand what the MAX is not. The MAX is not a scalping method. So we are not interested to catch just a few pips in the shortest possible period of time, for example, a few seconds or a few minutes. This depends, of course, of the time frame, because we consider that scalping the market is not so easy and perhaps the most difficult approach to trading. With higher time frames, with more important movement, it becomes so easier to trade. The MAX is not a news trading method. Of course, we can develop trades around the news, but we don't trade the news by themselves. We are not interested in trying to catch these important spikes the price is doing when we have an important news release with a big surprise, because these movements are extremely fast, they are very speculative most of the time in a first step, and we don't have good price executions. If you have observed what happened during a news release, the spread widens, importantly making any entry or exit a bad price execution. But after the news release or before the news release, we can, of course, in some circumstances, trade these news, in fact. And as I have mentioned previously, the MAXO is not an elementary buy and sell system. We don't use fixed rigid rules. Our rules adapt to the market conditions, and recognizing the market conditions is an extremely important behavior or a feature of the MAX. We define what we call price modes, and we have several types of price mode, like the trend mode, the concentration zone mode, the choppy mode, and the what have I made here? Sorry. Okay. And so the spaghetti zone, in fact. And so, as I have mentioned previously, we open a trade based on entry setups. And an entry setup is always defined as an opportunity which is based on several aspects. Just to recap: technical aspect, risk conditions, and global context. By global context, I mean what is the market sentiment, how the market sentiment may be influenced by the news release, by any events happening around the world which may have an influence in the market, so in the forex or in any other market, because the markets are, of course, linked together. Markets may be correlated positively or negatively. And on the contrary, an exit setup, when we have to close partially or totally a trade, will be defined as a risky situation. And the risky situations, whether the risk is a real risk or not necessarily a real risk, because in advance we cannot define, we can see simply that at one specific moment we may have a potential risk situation, which forces us to take a decision to reduce that risk. And so these risky situations are based on several types of exit setups. We have exit setup defined based on indicators. We have exit technique based on a pure price action. We have exit techniques based on a combination of price action, specific price action, and some useful indicators. We have also very important timing aspects, because not every hours during the day are made equals. And we have also a very important concept we call the movement invalidation. Sometimes it may happen that we are still in the trade and the price goes against us without giving us an exit setup, but at some moment we can say for sure that the movement we are seeing makes no longer sense for the trade we are handling, and so we have to close our trade. This is what we call the movement invalidation. So now this is what the historical max was. Since several years, 3 years approximately, we have pinpointed some challenges any trend following system may have. And the MAX, of course, does not escape these challenges, even if it is in a less important way. Some of these challenges are the following, and I will show an example of one specific of them in a moment. What happens when we have poor price action and so a small movement. And so by definition, because let me take the red spot here, by definition, because the MAX is a trend following system, when we have poor price action or small movements, it's difficult, in fact, to extract some profits. If the price does not move, we cannot have trade or we cannot have results. Sometimes we may have ample movements which are missed for whatever the reason. Because we are using indicators and some of our decisions are based on them, even if we don't trade indicator, we always trade the price action, but the indicators help us as tools to quickly pinpoint interesting situations. Because they lag and they have sometimes a lack of reactivity, this sometimes make trading poor price movement more challenging. And with the MAX, the historical MAX, we had to make the difference between a trend movement and a counter-trend movement. And sometimes we observe that an entire movement is made with a combination of a counter-trend and then a trend as defined by the historical MAX. And I have always found that it would have been fine to unify the two types of movement into one unique movement. And this is what we will do with the MAX ETF by redefining the trend we are trading and calling them directional momentum movements. And so because we are also using time bar charts, sometimes we lose some details in the price movement. And so with the MAX for now around 3 years, we have addressed these problems and we have introduced two important additional concepts within the MAX, the ETF concept, extended trading format, and the SAM, Super Advanced MAX. And today we have decided to introduce at least the ETF concept into all the level of the MAX in order to solve many of these challenges. Let me illustrate just one of them, just to give you an idea what may be the problems a trend following system may face. This is a set of charts showing the volatility or the evolution of the volatility of some pairs over time since 2010, so during the last 7 years. I would have preferred to show larger chart, but the historical chart I was accessing were limited to the last 7 years. But anyway, this helped to show the idea. We can see that over the time, we see that sometimes the volatility of the market of specific pair, here I take the example of the euro US dollar, is dropping in an important way. When we consider here, for example, this peak here, the average daily range was around 175 pips. And for the moment, it is around 100 pips. And so this means that the momentum and the volatility cyclically drop in a very important way, and when we are in such a low momentum and volatility period, which is the case nowadays, we have less opportunities to trade and we have less movement. The movements are smaller, and so this is one of the challenges we have to address. I'm showing here the euro US dollar, but it is true also for other pairs. Look here, the pound US dollar. We have regularly drops in the momentum. Of course, this high peak was due to the Brexit, which has increased amazingly the volatility of that pair, but the momentum and the volatility has dropped importantly since a few months now. And let me show you some additional examples here with other major. I'm always using the wrong button, so let me do that way. Okay. Now, I'm illustrating two other major pairs, the USD-Yen, for example, and we see that regularly the USD-Yen has increased and drops in its momentum and volatility, and for the moment we are on a low level momentum, and similarly with the USD CAD. And this is the case for all the major pairs, so all the pairs with the US dollar, but it is true also with other pair like crosses pair, for example, the euro kiwi, the pound yen, and we can see that regularly we have that cyclical feature of increase and drops in the momentum and volatility. And for all these pairs, we are again in a low momentum and volatility environment. And of course, this is not all. We can observe that in other pairs, for example, the pound Swiss here, the CAD yen. This is true, in fact, for any pairs. And so when we are in a very low momentum context, you see, for example, the CAD yen for the moment has a daily range, an average daily range of around 60, 70 pips, which is really small, because the daily range is the distance between the high and the low. And so, but this doesn't mean that the movement between the high and the low is a straight movement. Along such a movement, you may have drawdown, you may have pullbacks, important pullbacks, and so the resulting movement you can trade may be even smaller. And so I have just shown some typical situations of these drop in the momentum and in the volatility, but this is a general situation for all the pairs, in fact. And so what we have done is to address these problems introducing the ETF concept into the MAX. And the ETF concept, in fact, has the aim to trade more movement, so to catch many more movements on an historical chart, to trade larger movement when such larger movement happens, of course, and then to unify the two historical MAX concept, trend and counter-trend movement, into one unique directional momentum movement, in such a way that we will have many, many more opportunities to exploit and to profit. Now, let me show you some examples. And I will use a chart here showing the difference between the historical MAX and then the new MAX ETF. And the first example I will show concerns the MAX primer. And so you can see here a chart of the MAX, which contains some examples of the indicators we are using. I'm going to retake my red spot here. So we are using traditional exponential moving averages. We are using here an oscillator which is the stochastic of the RSI. Don't ask me about their settings. This is not the most important point. In fact, in any max level course, we show that the settings in an indicator is never extremely important. What is important is the relative behavior of the price itself with the behavior of these indicators. And we don't trade them, but we use them to quicker define some potential situations on a chart while the price is moving. And we have two types of special situations, an entry opportunity and then an exit opportunity. And so here, this was the Euro-US dollar in the 5-minute time frame a few days ago. I think it was last Monday, with the max primer, the historical max primer along that up movement. We had here an opportunity to open a trade we call a breakout safe and perfect move. This represents a set of conditions to recognize such kind of opportunity. We have a stop loss we call an emergency stop loss. The aim of the emergency stop loss is to protect our account if something goes wrong in our technical environment. For example, we may have our internet connection going down. And in such a case, if we are blind with the trade and the price goes against us, we need to protect our account. And so the risk we take for our trade is always based on that emergency stop loss. Of course, along the trade, we will adjust regularly that emergency stop loss in order to protect more and more the trade, and sometimes the profits also when we are in a risk-free trade. Whenever we open a trade, we consider the trade is made of 2 units. For example, if the trade size is 2 standard lots, 2 units will represent two standard lots. Of course, the size of the trade is calculated in a very specific way we teach in the course, and we call position sizing, but in such a way that when we recognize here an opportunity or a situation with a potential risk in our trade, we call that situation an exit setup. We have to close one unit. So we open 2 units here at the entry, we close 1 unit, and we call that exit a minor exit or a momentum exit. In this example, that unit has been closed, catching a small profit here, 9 pips, but it is what happens sometimes in trading. And then the movement resumes to the upside in the direction of the movement we are trading, and at some point here on this long bar, a long bar is always a good opportunity to bank some profit, because a long bar is a fast and ample movement, giving us a nice profit whenever this happens. And in this case, it was a good opportunity to close the second unit with a 27 pips profit on that second unit. So XXX in our jargon always means a final close of the trade, whatever the number of open units. It is important in the context of the max standard when we add the scaling process, the acceleration phase, because we may be left with many open units when we have to close the trade, and so the XXX means we make a final close of all the remaining open units. You can see also lines on the chart, horizontal lines in white, in orange or other colors. The colors are not important, but these lines represent price levels. We call them max price levels. And you can see here how this stop has nicely respected this max price level, and later in this movement, the price has respected that area where we had 2 max price levels. Now, the max price levels are not part of the max primer or the max standard. We produce these max price levels each weekend, each Sunday, sometimes a Saturday, and so they are updated once a week, and they are available through subscriptions. But you may have them available for free for a limited set of pairs, 4 pairs in fact, every Sunday, and then if you decide that they are good, you can subscribe for the entire set. We prepare these levels for around 15 to 20 pairs a week after week. So anyway, you see here the kind of result this trade has produced. So 36 pips with a stop loss of 25 pips. This represents a small reward to risk ratio, but a positive reward to risk ratio of almost 3/4 of 1 R. R represents the risk. It may be 2%, it may be 1%. For example, if you take a risk of 2% for that trade, your profit would be 1.4% for that trade, having last perhaps 1 or 2 hours in the 5-minute time frame. So this was an example of a trade during that uptrend with the historical max primer. Now, of course, with the ETF concept, we can make better. And in this case, the ETF is represented by these 2 additional lines in yellow and in orange, plus some companion tools we teach in the Max Primer course and in the Max Standard course. And in this case, instead of having been able to make one trade, starting here as previously and ending here, we have been able in this moment to add an additional trade here. So we had an entry here at this point, we call an ETF REMO, then an MX, and then our XXX. That additional trade was not a big trade, only 16 pips, but the advantage of the Max Primer against the historical Max Primer is we have smaller stop losses usually. Remember in the previous example with the first trade, here we had a stop loss of 25 pips. Now here the stop loss is only 16 pips. And in the first trade here, the stop loss is only 20 pips. And so when we close the trade and we calculate the reward to risk ratio for these 2 trades, we see that the first trade has produced a reward to risk ratio of plus 0.4 R, and the second one plus 1.13 Rs instead of previously 0.72 R. So we have increased the profit of the second trade here by almost 50%. And so globally, these 2 small trades have produced a nice reward to risk ratio of 1.5R, which represents, for example, 3% profits with a risk of 2%. Okay. Now, this is the max primer. But we can do better, and we can do better with the max standard, because with the max standard we have the accelerating process with the scaling technique. And I'm going to show you now what the historical max would have produced. We have, of course, the same entry as previously here. We call a breakout safe and perfect mode with the same stop loss. Of course, the setups are identical in all the level of the max. The only difference between the max standard and the max primer is in the max standard we have many more entries, setups and exit setups than in the max primer. And then we have the same scale out, or MX, minor MX momentum exit, or we can call it also a scale out. And then here we have a scale in. SC always represent a scale-in. Now, you can see that above that scale-in we have a max price level. If we don't use these max price level, the entry is made where it is marked on the chart. If we exploit these max price levels, the entry should have been made just above here. But there's just a small difference depending if we use or not these max price levels. And then we have the same scale out with the long bar here. But at this point we have closed 2 units, but because we have made an additional scaling, at this point we are left with 2 open units. Indeed, we have opened 2 units here, we have closed 1 here, we have opened 2 additional here, and we have closed 1 here. So we are left with 4 open units, and so we can stay in the movement. And we have again a long bar here, giving us the opportunity to close 1 additional unit, leaving us 1 open unit. We close here based on an exit technique we have and which applies in this area. And so you can see now the result caught in that unique trade along that movement. And so this trade produces with the max standard and only 1 scale-in, just 1 scale-in, 77 pips or 1.5 R result instead of 0.7 R result. So we have doubled the result compared to the historical max primer. And so 1.54 R with the historical max standard. Let me show you now what the max ETF has produced on this trade. And so we add our ETF tool on the chart. Of course, it is the same as in the previous chart. And this ETF tool allows us to make a previous entry earlier as previously with the max primer. We have the same MX, of course. And now the previous breakout safe and perfect mode becomes a scale-in for our new max ETF standard. Then we have another scale-in here, which would have been made above the level if we exploit the max price level. Then another MX, and then another scale-in with the same remark as the scale-in number 2, and then another MX, a last MX, and a last XXX. So the same movement with the additional ETF tools allows to make 1, 2, 3 scale-ins instead of 1 scale-in, without increasing the risk we have in the trade, or at least we have a strict control on it, because of course whenever we add a scaling to our position we increase the position size, and so if we don't pay attention we increase the risk of the trade. So we have approaches to control that risk and to keep that control and that risk under control. And another effect of the max ETF is we have a smaller initial stop loss, like previously 20 pips, if you remember, in the new max primer. And so when we make the accountability of that trade, we can see that that trade has produced through its initial entry and the 3 scalings 157 pips for 2 or 3 hours of trading, and because of a smaller stop loss, a nice reward to risk ratio of 3.93 R. This represents almost 8% profit with a risk of 2%. And we can compare that result with the result of the previous versions of the max or level of the max. So a very nice and important increase of the results. You see also a red rectangle here on the chart. This red rectangle our max traders have called the red magic box. as a special objective. In some specific types of movement we call true trend, we know with a 75% probability, so a high winning rate, a high success rate, sorry, when such a true trend will exhaust. I don't say when the trend will finish, when the trend will end, but when it will exhaust. You can see in this example that we have missed the very last portion of the movement before the price has reversed. But making a final exit in this area inside that red magic box was a good exit opportunity. And so a nice result, a nice increase of the profits with the MAX ETF. Of course, this was an example in the 5-minute time frame, but we can use the MAX in any time frame and in any instrument. I'm going to show an example, a recent example, which is still opened on the Euro Pound. The Euro Pound is known, and in the daily time frame, the Euro Pound is known to have smaller movements, but it is an interesting pair because the peak value is higher. It is around $13 per pip for one standard lot. And so with the historical MAX primer, so the only possibility to have a trade was in this area through what we call a breakout REMO, then an MX with a small loss, and then the XXX with a small profit. It was the only possibility to catch a MAX primer trade along that movement with a stop loss of 190 pips. So this was a very small profit. Personally, I consider that kind of result as a break-even trade, but anyway, a profitable trade. So keep in mind the number of pips, 40 pips, and the reward to risk ratio 0.11R. Now let's add the ETF to the MAX primer, and you will see that we are able to catch a larger movement, in fact starting right here. And the trend reversal has been made way earlier. We were in an uptrend, and this movement is simply the resumption of the previous up movement. And so here we have an ETF, MAX ETF primer and result we call an ETF REMO, and then we have an MX, and then we have an XXX. This was a first trade in that entire movement with an initial stop loss of 150 pips, giving a nice trade with 373 pips and a reward to risk ratio of 1.24R. And then we have another trade here, which is very similar to the trade made previously with the historical MAX. So a first initial loss and then profits, approximately balancing the loss on the first unit, so making a break-even trade, and then a last trade which is still running for the moment. So an entry has been made in this area, and we have still our two units as opened unit. So these two first trades has produced globally a reward to risk ratio of 1.25R instead of 0.11R, and we still have one running trade which will produce with certainty guaranteed profit. Chris, can you close your mic, please?
Well, actually, I wanted to say something, Eusebio.
Yeah. Oh, okay.
Yeah.
Please.
No problem. Hi, everybody. I'm Chris, based in New Zealand. Partners here with Chris and with Craig and Eusebio. I just wanted to point out, I've put some information into the chat area, and if you have any questions, please ask there. But Eusebio has given you a technical explanation of what the R value is, and some people get a bit messed up with it. What I find easier is that if you get into a trade and you will lose $100 if your stop gets hit, then the R value is a multiplier. So you just multiply the $100 that you would have lost, your risk, by 1.25 in this case, and that will give you what your profit is out of the trade. Indeed. So a lot of people like to think in terms of profits. So if you've got some idea on what you're likely to risk on a trade, we'll give you some idea on what your returns are likely to be. Okay, thanks, Eusebio. But please ask questions.
Yeah, no problem. And this was a good explanation. Indeed, some traders prefer to think in terms of percentages, other in terms of money. And so, but both explanations are, of course, equivalent. They are identical. So, and this is why the R is the multiplier, as Chris has mentioned, and it is linked to the size of the stop loss. And so the loss you can make if your initial stop loss is hit. So now let's see what the historical max standard would have produced on that movement. So, and we can see here that we have an earlier entry, which we call a PMO. A PMO or pseudo-MO is a special entry up in the max standard, and then all along the movement we have a series of MX and scale-ins. A first MX here, a scale-in number 1, an MX number 2, a scale-in number 2, an MX number 3, a scale-in number 3, an MX number 4, an MX number 5, a scale-in number 4, an MX number 6, a scale-in number 5, and we still have here the trade being opened with 4 open units. And so the trade is not closed, it is still running. And when we calculate the profits we have on that trade for the moment, with all the closed units, we have locked 630 pips, which represent for our initial stop loss of 250 pips, locked reward to risk ratio of 1.26R. This does not seem to be a big result, but we have still 880 open pips. Of course, we can lose a large portion of these 880 pips, but not all. And so this represents a potential additional 1.76R as an additional profit, but sooner or later these units will be closed, and perhaps some other will be added, because we never know how far the movement can go. But if we add the two results here, we can see that we have approximately 3 R's which are possible on that trade, which is way much important than what the max primer, whatever the version of the max primer, can produce. And if we add the ETF concept on this chart, we will get a very nice result here, but a very important result. So we are able to open a trade way earlier, and because we are able to open the trade earlier, we are able to add more scaling. We have up to now 7 scaling. I have mentioned here this scaling is a bit risky. There are reasons for that, but we can profit of more riskier situation under some circumstances based on the trade risk management. But it is always important to understand, to explain why a decision may be risky when we teach the max. And so here I'm mentioning the result we had at that moment. So at this moment we had 2, 4, 6, 8, 10 open units. And based on these 10 open units and all the MXs we have already made, we have locked 1,185, which are locked, closed. And with an initial stop loss which is smaller than previously, 170 pips, we have already locked a 3 point almost half R as a result. And we have here more than 2,600 pips which are opened, representing almost 8 R which are opened. Of course, if the price retraces, we may lose a portion, a fraction of that floating result. But based on our trade risk management, we will have a strict minimum here of 600 guaranteed pips with a guarantee of 1.76 R, additional R to our previous trade. And so we can see that when we add the locked result with what we can still extract from that movement, so we will have necessarily a very nice result. And we can compare these results with the previous versions of the max or level of the max. And this trade is still running. I have surrounded here the scaling number 3 because in fact in this trade through the MX, the 2 units of the REMO have been closed, the 2 units of the scaling number 1 and the scaling number 2 have been closed. And when the price reaches that level, in fact, we have already, and you will learn that in the Max Standard course, the scaling number 4 and the scaling number 5, which are already locked, in fact. This is why I mentioned here a portion with guaranteed pips or guaranteed R's. These represent what happens with the scaling number 3, 4, and 5. The only scalings at risk, with a small risk in fact, are the scaling number 6 and the scaling number 7. This is an example when we have an ample movement and we are able to add several scalings. At some points we are in a risk-free situation and the profit will grow in fact with the number of additional scalings we add, keeping the risk under control and making the profit growing and growing and growing as long as the movement continue to unfold. At some point, of course, the movement will exhaust, in which case we will have to close all the open units. So this is what the max standard and the max primer has become with the ETF concept. And of course, we don't have a 100% winning rate. We will have also losing trade with the max ETF. And this is an example, a typical example of a losing trade. The important point to consider is with the max, whatever the level of the max we use, we always have small losses when we have losing trade. This is a typical example. We were in a downtrend here, and at some point, at this point, we had an entry setup to take a short trade, a remo. And immediately after the trade has been opened, the price went against the trade, forcing us to make a first MX, so closing one unit with a loss, of course, and then later closing the second unit also with a loss. And you can see that the addition of the two losses gives a loss of 22 pips. With our initial stop loss of 24 pips, this represents a loss of minus, there is a small typo, you should read it as minus 0.46 R, so a little less than half R loss. So a small loss, okay, compared to the potential profit we can extract when we are able to catch the beginning of the trend. I have mentioned that we defined in the market, in the movement we are trading with the max, several price mode, the trend mode, the consolidation zone mode, for which we have to make the distinction between a tight consolidation zone mode or a squeeze and a large consolidation zone mode or a range, and the choppy mode. The choppy mode is the most difficult mode to recognize in a market, but when we recognize such a choppy mode, and this is a typical example here, with the max standard or the max primer, it is extremely rare to have a valid entry setup and so to have a trade. With the max ETF, we may have some additional opportunities even during a choppy mode. And so we may have, for example, one trade opportunity in this area, one in this area, one in this area, one in this area, and another one in this area, and then a last one here. So in this time period during the ASEAN session, and after all it is the pound yen, so we can trade the pound yen during the ASEAN session, we have in this very choppy environment around 6 trades opportunities. And when we have such a max ETF trade opportunity, knowing that we are in a choppy mode, we have to handle these kinds of trades very, very carefully in order to optimize the probability to extract a profit from these trades. With the max ETF, even in a choppy mode, you see such kind of movement will give us a profit even in a choppy mode. This movement is large enough to extract a profit. This movement perhaps will come at break even. This movement here will give a profit, this movement will give a profit, and this one will give a profit, and after that the price went out of the choppy market, of the choppy mode. So with the max ETF in a choppy mode, we have more valid setups, not a lot, more than previously, but we have to trade them very carefully, and we teach in the max courses how to handle these kind of situations. So now in terms of money management and the compounding effect is always an important aspect of any trading system, especially in the context of a trend following system. If you compound your profit, you can grow your account very, very quickly. I will not give a long explanation here. Let me just give some example. Let's suppose you start with a trading account of, let's say, $10,000, and you take a risk of 2% for each trade. With the max primer, you will have an average reward to risk ratio between half R and 1 R for each trade. With the max standard, and especially with the max ETF, you will have a minimum of 3 R's profit on average. Let's consider something very, very conservative. Let's consider a 1 R profit on average. This means that if we consider an average stop loss, for example, in the 5-minute time frame of 30 pips, we have rules to fix the stop loss, of course, and the rule is not a fixed number of pips. It depends what the price is doing. But when we make some projection, we have to consider some assumptions. So let's suppose an average stop loss of 30 pips, and let's suppose we are able, through one or several trades during the day, to catch a 60 pips profit. This means a 1 R reward to risk ratio. Remember, our trades are made of 2 units. And so when we add the pips of the 2 units, we have to divide by 2 in order to have the reward to risk ratio, because using 2 units, we have to average the result by dividing by 2. 60 pips will be the result of the 2 units. And so if we divide 60 by 2 and then by 30, we get that reward to risk ratio of 1 R or 1 to 1. And let's suppose our objective is to double our initial trading capital, so from $10,000 to $20,000. Then we can see that trade after trade, we make our trades, we make the assumption we achieve our objective. And so after 1 month here, 21 days on average, the account has grown to $15,000. So we have increased the account by 50%. And the account is doubled after 36 days. Indeed, here, the level of $20,000 is achieved after 36 days. Of course, this is only a raw idea of what you can obtain, because the reality is never so ideal. Even if the objective is very, very conservative, there will be days when you will make a larger profit. There will be days when you will make a smaller profit. There will be days when you will make a loss. And there will be days you will not trade, because you don't necessarily have the possibility to trade every day, especially in a small time frame. But this will give you a raw idea of what can be achieved, even with a very reasonable reward to risk ratio or result in your trade. And of course, later, if you consider what may happen later here with more important objective, for example, if the objective is to multiply the account by 10, and if you apply the max standard instead of the max primer, for example, so instead of considering a conservative result of 60 pips, you consider a more aggressive result of 100 pips, you can see that you can achieve your objective of multiplying your account by 10 after 75 days approximately, or 4 months. 4 months. Of course, the assumptions I have taken are strong assumptions. Now, don't get me wrong, it's not so easy. I have made the assumption that we trade every day, and every day we are able to achieve our minimum objective. But the reality may be different. As I have said, some days we will make more profit, some days less profit, some days we can make a loss. Whenever we make less profit or whenever we make a loss, a losing day, this will increase the number of days necessary to achieve our objectives. But you have a raw idea of what you can achieve, provided you achieve the consistency in the way to apply the max. And one of the reasons of that is simply because we have a strict control of the drawdown when we are facing losing streaks in trade. We can even have a complete control on the drawdown, and this is something I teach, for example, in the Max Advanced course. We can predefine a maximum drawdown, let's say of 15%, and by applying a specific procedure, we are guaranteed to never exceed that maximum 15% drawdown. Well, so the max courses are organized in 5 levels as previously. we have the Max Primer, and now we will call them Max Primer ETF, because it includes the ETF concept, the Max Lite ETF, the Max Standard ETF, the Max Advanced course, which should say also the Max Advanced ETF, and then the Max SAM ETF, where I teach the additional concept of the Max. And this is the level where we go much more into the details of the price action, including the exploitation of other price representation like Renko bar chart or constant range bar chart. And so the aim of this presentation today is to propose to you, as Chris will mention and Craig will mention in a moment, the Max Primer ETF course and the Max Standard ETF course. And so just to conclude my presentation here, with the Max, whatever the level of the Max you will use, you will have a trading methodology which is based on sound concept. And during the course we explain also why this concept works in relationship with the way big traders in the market trade themselves. And the training, in fact, we have with the Max reinforce some very important aspects. We use indicators, but we do not trade indicators. We make our decision based on the behavior of the price action. The indicators are there to help us going faster to pinpoint interesting situations, potential interesting situations. So we have a solid trading method, very solid, and with a sound risk and money management technique. And if you have perhaps perceived what I have explained in the example I have presented, we have always a strong focus. This is always our first priority, a strong focus on the trade risk monitoring. Once we open a trade as a Max trader, our first priority is always to control the risk we have on the trade, never the profits. Our objective is to reduce or even to cancel the risk we have on the trade, and then we can consider to optimize the profit we can extract. And so we also insist on the personal confidence development through several activities, additional to our Max courses, the coaching or mentorship activities, the homework. This is an important aspect Chris will describe more in details in a moment. The practice, we have practice sessions. We have some follow-up support with our forum, with our workshops, and sometimes with our scrolling parties where when it is an opportunity to give some additional tips or some new adaptations we can consider depending on the market conditions or nuances, in fact, depending on the market conditions. So this is the presentation I wanted to make to you about the Max trading system. I hope you have enjoyed that presentation, and now it's my pleasure to give the mic to Chris for him to present some additional important aspect of the Max. Chris, it's up to you now.
Okay, thank you, Eusebio. I'm one of the three of us here in the Max trading system. This is our 55th set of Max courses. It's been a huge number. We've been running since Jim started it. He ran his first course in 2007, but we started running as a group in about 2008, and we've had over 1,900 members, coming up to 2,000 now. People go through the courses, so we've been around a while and kind of know what we're doing by now. But we're not the flashiest at marketing side of things, so bear with us. One of the most important parts of the course is the homework. Eusebio has shown you how well the methods work and can increase your profits and really expand on sort of what a regular trend system can do. The homework is what actually cements it in so that you can actually use it. A lot of people get these courses and think, yeah, this is really great, I'm going to make huge amounts of money, and then it all fizzles out when the mouse hits the screen kind of thing. So what we do is we ask you to do a couple of charts and send them in. The reason for it is that all you need to do is mark up the charts, and by doing that, that will really make sure that you understood the information correctly, and we'll be able to check it. What happens a lot of times is that people think they've got things right, but they don't. and it can be completely wrong. Got the like I've looked at indicators and have been reading them left to right instead of top to bottom, and vice versa as well. And it's only until somebody from the outside comes in and checks your work to make sure that you're doing it correctly that you actually get the feedback that you're doing it right. Thanks. So here's an example of the homework. It's the chart. It shows where the entry and the exits are as you're taught them as you go through with the correct markings and the stop losses, etc., etc. And then an example of what the homework replies are like. So there's quite a bit of detail in them, and generally we address them almost bar by bar at times. So next chart, please, Eusebio. So here's a table showing the different course comparisons. We're selling two courses today, the Primer ETF and the Standard ETF. You need to do the Standard before you can do the Advanced SAM or the Advanced or the SAM course. You don't need to do these in person. We also supply them by video. So there are people all around the world here. This course is run at 4 p.m. US time, and that's not really good for, say, the European side of the world. And I get a bit grumpy with them based down here in New Zealand as well because they're quite early morning. People in India and South Africa have similar issues. So we can supply the videos for each course. The immediacy of live presentation isn't there, but all the information is, and you still get to ask all the questions. There's no problems with that via the Google Groups. So back on the courses, the Primer, the difference between the two is the Primer runs for 2 weeks and the Standard runs for nearly 2 months. So there's quite a bit of information to be covered. The number of entries, the Primer is 2 plus another, actually it should be 3 ETFs. The extra one that was there was for scale-ins, and they're not taught in the Primer course. The Standard ETF has got its 7 basic entries and another 4 ETF entries. So there's quite a number of ways that you can actually capture the market there. On the exit side of things, we've got all of those covered. 4 for Primer, over 20 different exit types. A lot of them the same, but replicated for the Standard. So that if you look back at, or if you remember back at Eusebio's charts, he was getting out very much at the tops of at the ends of the movements themselves. And because we've got so many different exits and exit criteria, we're able to capture most of the trend movement most of the time. Not always, but they're really, really good exit conditions. The Standard has got the profit acceleration built in. This is the scale-ins, being able to pyramid in whatever way you call it. So the difference between the two courses is that for the same trade, and you will have seen this on the previous charts, the Primer will produce, say, $100, and if you're using Standard with it, Standard ETF, then you can make another 30% to over 300% from that same movement. Just depends on how long the movement itself is. And this is presuming it was a nice movement, not just a short, sharp blip. The money management side of things is included in both of them. Standard has got a bit more enhanced because of the scale and techniques. Homework is required not required, we will do your homework if you do it for both of the courses. And once you've done the courses as well, it's not like, hey, thanks for coming, see you later type stuff. Almost every week we have a free practice session on the weekends. So we go through charts, again, bar by bar. Eusebio gets to practice new pieces of information and new ways of training on you during that period, and you get to ask whatever questions you want. The courses themselves are very detailed and precise. When you find a setup, like an entry or an exit, then the execution occurs within half a pip to 4 pips these days. Because the ranges are so small, we can execute things a lot in a tighter manner than before. It's all very fluid. It depends on what the market's doing. We use the MetaTrader platform because there's no fees and there's free data feed. Everybody can access it. And we use the same platform for everybody. Even on a 5-minute chart, if people are using a different MetaTrader platform, then the candles can be different. So we don't promote the broker. We just use this broker's particular platform because the weekend bars are nice, and it opens and closes at 5 p.m. US time. The course materials, we provide everything. So once the course is finished, within 24 hours you get the video, all the PDFs, the notes, examples, any demos that we do during the course are all provided to you. We have backup help videos to get you used to using MetaTrader if you've never used it. It's pretty simple, and the videos will show you step by step how to get into things. They're only 5 minutes in time each. And there's a, excuse me, and while we're running the courses, we have a chat session running at the same time. It's not the one that's in GoTo, but it's a completely separate one, so that we've got backup if GoTo dies and vice versa. If the chat dies, we've still got the GoTo one. And that's running concurrently with the session, so that you get to ask questions, you see what other people are saying, and we get to see what you're asking about in real time, so we can get at it straight away. Also, as of course, regarding the MetaTrader platform, we provide all the templates and the indicators. So all you do is just drop those in the right folders, and then go to the chart, open up that particular template, and you're ready to start using the Max template. Okay, so the whole idea on this is the final result is that you'll end up with a really solid trading method. You'll have about 5 different entry types for primer. The entries, the types won't come around quite as often as the standard do, but they'll still be there, and you can still profit from it. It's a profitable system. The difference with the standard is super profitable because of the scaling. So like I said, you can make 30% to 300% more when the market is moving nicely. We will supply you with as much support as you ask for. Just send the charts in asking for it. We know that trading is not easy, so we want to give you a really good method, a good system, and we want to give you all the support that you want. So essentially, like I said, you ask for it, we'll do our best to supply it. And hopefully, with practice and persistence and perseverance, you'll achieve your goals. So pricing-wise, the Max Standard, now with the ETF included, gives you more entries and tighter stops, and the profit acceleration runs for 7 weeks and starts the 10th of September, and normally the price is $2,999. We've got a webinar special on at the moment for $2,399. And as Craig has written there, the payment plan's available if you want. Just ask him for it. Craig has also put together a package deal with 3 courses: the primer, the light, and the standard. The light has got 1 extra, maybe 2 extra entries compared to the primer, and a few extra stops, a bit more detail in it. But the total price for that lot is $2,679. So it's a complete, almost 4 months worth of training that you would get, plus all the homework, plus everything else that goes with it. And the link for it at the bottom there, we'll be putting that up in the GoToWebinar chat area, so that you can just click on it. It is down there at the bottom. And we'll also be sending the links out via email. So normally it's $2,999 for the standard ETF, and our webinar special for the next little while is $2,399. And the other offer that we have is the Max Primer ETF. So this is much shorter. It's only designed to give you a taste. Like I said, it is profitable. So we're not here to mess around. We want to make sure that you trade safely and know what you're doing. So it will give you the basic entries. It's profitable. It runs for 2 weeks, starting September the 12th, and the normal price is $329. But we have a webinar special for the next little short while for $159. And if you just wanted the primer and the light, the 2 low-end courses to start with, then the combined total is $759. So it saves about $300 on the 2 packages. And it's got a different link at the bottom. We'll put that through as well. Right. We've had some questions come in so far, and if you have any questions about what we've spoken about or other parts of the Max, please feel free to ask them and we'll get through them. Bob has asked, is there an extra charge for the ETF indicator? And that answer is no, there's no extra charge for it. Okay, how do I pick an entry? How do I know when to exit? And in the courses, we go through all of those in quite a bit of detail. Okay, seems like all the questions have dried up here. Sorry, just one more thing. At the end of this week, Eusebio, for the non-farm payroll, will be running a free session there as well. So it'll be a live session. So we'll let you know, we'll send through the links for the non-farm payroll session at the end of this week. If you have any questions for us, please feel free to ask them via our contact details down there. We're on Skype most of the time. Or just say hi and we'll add you to the list, and happy to chat with you, time permitting. Thank you very much for your time here. I'll see you later.
Thanks, everybody. Bye-bye.
Okay. Thank you, everybody.
Bye, everyone. Have a nice week.